Welcome to the Family Banking Show with your hosts Rob, Derek, and John, where we dive into the world of the infinite banking concept and discuss personal banking strategies to secure your legacy and build generational wealth. We're glad you're here, and we hope this episode serves you well.
Welcome back, ladies and gentlemen, to the Family Banking Show. We are your hosts, Derek, Rob, and John. Guys, how's it going this week?
It's going good. It's cold.
Man, it's freezing. My office is down in my basement, and I don't know if there's proper insulation. Probably not, but the temperature in my basement was 52 degrees when I came down.
Your
Started
thermostat
the
is upstairs.
fireplace. Well, yeah, no, I mean it actually was. I was like kind of shivering working for a little bit until it warmed up. So I know we always talk about weather, but Minnesota weather is actually like always changing in some way or another.
Yeah. Yeah,
It
you both
reminds
of you guys are next to the windows too, and it's always nice and drafty. So
reminds me when I was in college, my first a couple years I stayed with my uncle and aunt up in northern Michigan, up in Calumet, Michigan, and I was in the attic in one of
Cool.
the rooms and it wasn't heated. And I'd have like blankets over me studying, doing my calculus. And I remember looking over and seeing like whiffs of snow puffing through the window. Oh my gosh. This is this is crazy. And then as soon as I move out and they have to put one of their kids up there, then the heat then they run heat to that room.
Crazy thing is my 3-year-old daughter, like last year, didn't want to touch the snow, wasn't interested at all in getting outside of the cold. And now she doesn't even care if it's like 4 below, which it is today right now. She's ready to go out and just like a long sleeve and like hardly any coats or whatever. And I'm just like, this change
What's
is
up? Yeah. Is that crazy? What's up with kids? I see kids walking around with like no jackets or hats or like shorts and long sleeve shirts and it's 0 degrees.
the winter superpower, I guess. I don't know.
Yeah. Hmm.
too cool to wear that stuff.
Yeah. Nope.
All right, guys. Well, this episode we are continuing talking about life insurance riders. If you enjoyed our last episode, we're going to dive a little bit deeper into four semi-unknown, unless you're in the life insurance space, what these riders are. Just by way of review, a rider is simply an add-on feature that you can include in a life insurance policy. There is an additional charge for these. Some of them that we covered in our last episode were kind of auto includes for us. And many of today's will also be some that we would strongly recommend and suggest to our clients. So guys, why don't you start us off? We're going to talk about what's called the Premium Deposit Fund, or a PDF rider. Somebody want to just cue the conversation, what a PDF is and how it can be utilized?
Yeah, the PDF is totally optional. I would say this is not one that we say by default you should look to add this to your policy. The premium deposit fund is a fund, right? It's just a place that you store additional capital outside of your policy that the insurance company is holding for you. It's earning a respectable interest, if you ask me, that will pay for future premiums, right? So we've talked probably in the past many times about a modified endowment contract, not being able to put too much premium in compared to the death benefit and so forth. So a way to have dollars still working for you. Granted, it's not in your life insurance policy and providing like additional death benefit. They are working for you. And in turn, over the years, however long, it may be, it'll pay for your annual premium for a set number of years with the planned interest rate that you're locking in when you first transfer those dollars to the life insurance company.
Yeah, great way to explain that. Yeah, basically you're funding future premium that's going to be drafted against a large lump sum. So to give some numbers in context, let's say that you decided to allocate $100,000 to the premium deposit fund, and your annual premium was $10,000. So right there, the life insurance company knows that they have 10 years worth of future premium that they can draw against in that account. Some things to keep in mind: the interest that is accruing is taxable income. But we, before this call, we're just talking about some unique tax strategies. So if it's something that you'd like to learn a little bit more about, please reach out. We'd be happy to help walk you through that scenario there. When does this make sense for somebody? When would we recommend this, and why not for others?
I would say unless you have other opportunities to perhaps earn greater returns, have less risk, and you don't really like, unless you have a better place to store a large lump sum of cash, then this could be a really powerful way to fund your probably bigger policies, I would guess, because the lump sum is, especially in the first few years, it's accounting for the capitalization period and kind of the upfront liquidity loss until now you're ready, say year 10, to start contributing new money and new cash flow to your policy. Now you're putting in $1 and it's definitely giving you, well over $1 in cash value immediately. So I would say unless you have a greater opportunity where you just know with certainty or with a great degree of certainty that you're going to benefit to a greater degree than what the PDF would give you, then it would definitely be something to consider. But otherwise, this is not a very common thing, at least in my experience, to have tons of people with, hey, I have $500,000 just sitting around. Do you think I could maybe put it in a PDF? That's not very common. But if something like a retirement account is liquidated and you want to store it for future premiums and just have a fire and forget type of strategy, absolutely. Like you mentioned the $10,000 annual premium with the 100K. Actually, with the 5.5%, right now, and we'll see how interest rates change, that would probably get around 140 total K in premium.
Yeah.
So that would probably do like 10 years of like a 14K premium.
Right.
And get more bang for your buck. So that 100K isn't just stagnant, it's not decaying, it's definitely working for you and funding those policies. And in my opinion, I think it's just a little cheat code to be able to overcome the capitalization period without feeling like your new dollars are illiquid, but rather you're just handling that with old dollars that you probably weren't using for wealth building or opportunities before anyway, from what I've seen when it is used.
Yeah, so some maybe life events that, hey, what happens when I get a big lump sum of cash? Maybe it's a loved one passes away and you receive part of an inheritance, or you're selling your business or a piece of real estate property, and you're looking at, I don't really need any more investments. I don't want to manage any more properties, but where is a good safe place to park some cash in the meantime? The PDF rider is a good option in those scenarios. The next one up, guys, is the overloan protection rider, which is unique to some carriers. It's not every insurance company has this feature. But Rob, go ahead. Maybe give us an idea of what the overloan protection rider is.
Yeah, the overloan protection rider is something one of our carriers that we work with has specifically. It's a rider in the policy where, as infinite banking practitioners, we work with our clients to specially design our policies so that they are infinite banking style policies, where we have the base, the smaller base portion and the larger paid up additions portion, and we use it as our family bank through life. And we design it so you're just kind of right at that MEC limit with some cushion. We don't want to get too close to it, but that modified endowment limit. This overloan protection rider, if for some reason the owner of the policy has, the action of the owner is the most important, as Nelson said, the action of the owner is the most important factor to the success of your family banking system. If the owner of the policy does things in a way that gets it to where it will become a modified endowment contract, that rider will kick in and it'll prevent that from happening. I think all the carriers that we work with will notify you, like, hey, you're getting close. This is to the MEC limit. You'll get notified. But in this particular case, this rider just automatically converts it into reduced paid up. takes away all the riders, so you can't do anything as an owner to mech it. So it's just a nice protection, just that extra little bit of protection. Doesn't have a cost. That just just to give you that peace of mind that you can use it as your family banking system and not get yourself in trouble if you weren't paying attention, over the years.
And part of that is the passive income years that we end up taking as part of infinite banking strategy and just as part of receiving tax-free passive retirement income is you have the option to take loans, over those retirement years. And if you, strategically do it, you can have it even where, because obviously these policy loans have real policy loan interest, and you can have that accrue and honestly compound over time because whatever you're doing over time will compound. Either you're earning or you're charging yourself interest. And so if it gets to a certain point where that compounding puts you in any sort of danger to where your policy can lapse, it also protects you in that way. Um, and so we were just talking about like if it's wise at that point to surrender your policy, which we in most cases I can't think of currently like when a good time to surrender your policy would be. But if you're to do that, just for everybody's general situational awareness, if you have a ton of cash value policy loans outstanding, above and beyond your cost basis, aka like what you've put into it, and then you surrender the policy while you took those policy loans tax free, as soon as it's surrendered, you will be taxed, on the gains, technically, of what you were able to receive because it's no longer a loan. It's no longer, even a life insurance policy that you surrender. So we'd always caution clients and policyholders to understand exactly what's going on when they take policy loans, how long they're taking them, and particularly like the protections they have in place so that a policy wouldn't lapse and you end up with either a mech like Rob's talking about or some sort of tax implication on the back end that nobody really wants to deal with.
Right.
Good stuff, guys. Yeah, this next rider is called the GPO rider, or some carriers that we work with call it the OPI rider. John, why don't you go ahead and kick us off here and talk to us a little bit about GPO?
I see you're making the former military guy define all the acronyms. GPO is a guaranteed purchase option, and that's with one main carrier that we use. And then OPI is OPAI, the option to purchase additional insurance. And both are very similar, if not identical. And we generally see these for juvenile policies for kids, in their childhood, where you can add this rider for very, very, very low cost. I have it for both of my kids, and even some people in their early 20s will get this, but really it's a protection in place, kind of like convertible term. I see it as like a backdoor convertible term where you are locking in a health rating and the option, and you're guaranteeing yourself to be able to purchase additional whole life policies with your current health rating and then the attained age or whatever age you're purchasing the new policy, in chunks at a time, right? So convertible term, you can do it all at once. You could do it in chunks, but here it's specifically in chunks over 10 different instances over like generally every 3 years. Once you start, I think it's at around 19 years old and every 3 years thereafter. So say like a child has a policy, right? And then they turn 19 and they have additional cash flow that they want to, store their capital in the best place possible. Then they have the guaranteed option to purchase a brand new whole life insurance policy up to, it's generally around 200 or 200K, 250K in death benefit, as a new policy without any underwriting, financial or medical, and have this brand new policy that's going to start kicking for them for the rest of their life and so forth every 3 years or in any significant life event. So if you were to get married, have children, then those are also like triggering events where you can purchase a new policy. So they have certain limits and different things in place for us to keep in mind, but generally it is incredibly powerful because the last thing you want is to have a healthy child that Lord willing is healthy for the rest of their lives. But if that doesn't happen, and we do live in a broken world, and kids can get sick in some ways, and then they're in their adult life and they have whatever it may be that makes them medically uninsurable, you've now locked in their rating as a child that generally more and more children are healthy than compared to adults, that they can benefit for the rest of their life and be able to continue to expand their system and build their own family bank, add to what you've already set out in your vision for generational perpetual wealth, that you don't have to worry about any other medical underwriting, just like a guaranteed like convertible term would do for you. So
Yeah, I think if you read through the rider, it ends right around 44, 45. So you can do that every 3 years or life event up to about 45 years old.
and generally most people make more money when they're 44 than when they're in their teens or even early 20s. So again, it's just another way to prepare for additional capital flowing through your hands that you can first store in the best place possible.
Mhm.
Yeah, for those who are truly serious about taking multi-generational steps and starting a family banking system, the OPI rider or GPO rider that John's just discussed really makes a lot of sense if you've got young children, or even if you're a grandparent and are looking at ways to transferring wealth to future generations. That's a great opportunity there as well. So great stuff there. And our last one, chronic illness rider, which my man Rob is super thrilled to be talking about. So
Yeah, it's a great rider. I mean, that's just, we talk to people. I don't just in general, we've been talking about riders these last two episodes, but riders are like that, the permanent whole life, dividend paying permanent whole life, just, with the companies we work with, these policies have so many benefits. And the riders are just an example of all of the benefits. I often call it it's a savings account with superpowers is the way I say it sometimes. And those superpowers, a lot of those are the riders. And one of the riders, I'm going to talk about now, chronic illness. Like that doesn't have a cost. It's part of policy, comes with it. But that's such a powerful rider because one of the things that people say you'll hear often is, well, what if I become sick or something and I can't pay my premium? What happens then? Well, this rider covers that. Like it. So if you can't do 2 of the 5 daily activities for a living, you can utilize this chronic illness rider where you can take out monthly, bi-monthly, and semi-annually, annually. You can take out cash from your death benefit that you can use to pay for your care at that point, to help for your care while you're dealing with this chronic illness. And that you can and you can use that until your death benefit is used up. I mean, so that's just a great safety net for people. Just another benefit that comes with these whole life policies, part of one of the superpowers, that comes with these policies. It's super powerful. So, there's just so many protections built in that people aren't aware of. And I think that's why I think our conversation about riders is so important, to just educate our clients and future clients that there's just so many benefits to these policies that just you're not aware of. And yeah, they're wonderful tools, wonderful products.
So, Rob, you had mentioned not being able to do, or only being able to do 2 out of 5 basic life functions. Let's just maybe hash out what are some examples of those life functions. The ones that come to my mind are obviously eating,
Yep.
or bathing, being able to take yourself to the bathroom.
Yep.
What am I missing a few? Obviously, there. What are some other ones that you guys are thinking of?
Yeah, let's see. Let's see, chronically ill. Yeah, so is it bathing, transferring, like being able to get it in and out of the bed, from the bed to the bathroom, like you need help, with that, dressing, eating, yeah, eating, dressing, transferring, bathing, toileting are the ones that they're listing. So yeah, it really can be just another safety net within a whole life policy that people aren't aware of that are just really powerful benefits.
And you had to have been diagnosed from a physician that you are
Yep.
chronically ill. It's not
Right.
just like somebody's on hospice, maybe for who knows what, but maybe that was
Yeah.
a chronic illness. But yeah, you had to have been diagnosed with a chronic illness
For a
from the
period of 90 consecutive days.
right, right. Okay. So
Yep.
after the 90-day period from the diagnosis, that's when you can start receiving some of that
Yep.
income, so to speak, from the
Right.
insurance company or from your life insurance policy. To the idea behind it is to help pay for some of those medical expenses. So
Right. And in this particular case, it could be up to 240,000 a year. So 20K a month in tax-free income that you can use to pay for your health, your needs during that time.
yeah, yeah, definitely makes a lot of sense, I would say, for many people. And especially the younger you are, the more it makes sense because you don't know what's going to happen 40 years from now, or so this is a good option for many people to strongly consider. And just the sheer fact of medical expenses are getting crazy. They've been crazy, and they're probably only going to get crazier. And so this is an opportunity to help offset some of those expenses if somebody qualified for it.
Right.
It's a big if, but I think it's a smart thing to consider when designing a policy. So yeah, thank you, Rob. John, anything you want to add to the chronic illness section?
Yeah, just you're setting yourself up in all of these cases, just like Rob is talking about with the superpower or the savings account with the superpower. You're setting yourself up for a win in so many circumstances that honestly, when I started my policy, I didn't know too much about the chronic illness accelerated benefit rider. Um, but the more I think about it and the more I'm interacting with clients and people now in their retirement age, like long-term care insurance is expensive. It's very expensive. And if you like in your 20s, 30s, 40s are able to become your own banker, recover probably 6 or 7 figures of dollars that you're otherwise losing to banks. Plus, like you're not probably going to have to pay for long-term care insurance, which is around, I'd say 8 to 20K a year, depending on, health and other factors. That's significant in your retirement, years and taking from your retirement income that you could already have covered, early on. So you're just setting yourself up to win where you have a huge death benefit, um, or you probably have a significant death benefit and you cover for your long-term care in tax-free income. Uh, so yeah, it just in any case, we want everybody we work with to one, just have the most value into their lives as possible from us to them so that they can create value in the world. But two, like that in any circumstance, that they have a peace of mind that they're going to succeed. And you don't have to be
Right.
ultra wealthy to be able to set yourself up for this stuff.
Yeah, it is worth noting that a chronic illness acceleration benefit is not technically long-term care insurance, but there does appear to be a lot of overlap there between long-term care and this rider, to where the death benefit from your life insurance policy could help cover many of those expenses that are common to also long-term care. It's probably worth noting that long-term care insurance, my assumption is that it would cover more life events than just the chronic illness phases. But it definitely is I still think, a smart play to have in a life insurance policy. So.
And it's like, it comes with it. So it's not even, that it's just baked into it. So it's just a wonderful rider that comes with the policy that,
Yeah.
the policies that we, create for our clients.
Mhm. Well, good stuff, guys. Well, I'm excited for our next episodes as we're approaching the Christmas season. I hope that our listeners are getting a lot of great value out of this past year. If you are interested in learning more about the Family Banking Show and how to get started with your family banking system, please send us an email, reach out to us on thefamilybankingshow@gmail.com. Many of us are also on LinkedIn. If that's a place that you prefer to connect with professionals, you can certainly reach out to us via that platform as well. All right, guys. Well, thanks again. We'll see you in the next episode.
Thanks, guys.
Thank you for joining us. If you're interested in a conversation about anything we've discussed, you can find our contact information in the show notes below.
And subscribe, follow, and leave a review to help spread this message and to help families across the country discover the generational blessing of IBC. May God bless you, and we'll see you next time.